Good morning. Good morning. Sorry about that. We're gonna have a little interruption this morning. The Tampa Bay Times did an interview you saw in the sales meeting on Tuesday, and they're sending a photographer out this morning. So I felt the need to clean my desk. So I ran behind schedule. Sorry about that. So very good. So I assume Mike Hajek, are you meeting? And I think Lucas is joining us this morning too. Let me see if they're there. Cool, guys. Well, I'm excited about this. You know, there's a story that I've read and been told a long time. And I've started reading a lot of books by Robert Kiyosaki. Hey, Lucas.
Hey, Craig. How you doing?
Good. Robert
Can you hear me all right?
Oh, yeah. You're loud and clear. Robert Kiyosaki is a very rich guy. He wrote Rich Dad, Poor Dad. And he's got all these concepts. And one of his concepts is you'll never get rich paying taxes. Right, but taxes are like death. They're the one thing that happens to everybody has to deal with. So I thought it'd be a good time of year, since it's March now and April 15th is coming up, that we talk to some people about some tax advice for independent contractors like yourselves who are working hard to make a living. But if there's some things you could do, not to avoid, you never want to avoid taxes, but lessen your tax burden, you want to take advantage of that. So I'll tell you some background. So Ben was our acting CFO back in the day when he was still with us. And then Ben left and Joy really stepped up and just took control of the finances of the company. She's done a fantastic job. But at the same time, we had a developer client of ours in St. Pete who, turned us on to this guy named Mike Hajek, who is our now CFO. And what a chief financial officer does, he guides the company and the means of its finances. We're going to have our taxes done for the first time by tax season, which we never ever do. And so one of the things Mike did is he appointed Lucas to help Joy. So Joy's got help now, and they work together a lot to make sure everything flows and we're as efficient as we can be. And so that's kind of where we're at. So I guess we're going on our second year now.
Yeah, it's going on our second year.
First year was a learning curve, lots of things to figure out.
Yep.
And I was talking to my brother yesterday about different things we want to push on and clarify even further, because we want to be as efficient as we can be, because these times are crazy.
Most definitely.
Yeah. So where's your fearless leader? Is he not going to show up?
That's why I turned off my video for a minute. I was trying to help him turn on Zoom. So he said he turned it off and then he was trying to rejoin. He was having some technical issues.
Oh, okay. So Mike, keep an eye out. Maybe he's going to rejoin as Mike Hajek. Let's see.
Mute. Ah, there we are. Good morning.
Good morning. Cool. All right, we're going to get interrupted in about a minute. Oh, that's so funny. So a woman named Ivy is coming to take my photograph because they're doing, I don't know what we did. They said we ranked very high in the Tampa Bay Times top best places to work, top workplaces. So they interviewed us on Tuesday and they did our Zoom meeting with us. So they're sending a photographer to see how we do it here today. So I can see her pulling in my driveway right now. So, and she's got her mask on. It's so funny. So Mike, I was given them a bio, and personally, Mike and I have never shook hands. We've never really met in person. We've done a couple of Zoom calls back and forth, but we talk 3 or 4 times a month. Yeah, and you tell me what not to do when I come up with a crazy idea, which I appreciate.
Well, I think anybody that knows you knows that if I'm telling you not to do crazy ideas, it's 3 or 4 times a week that we talk.
Right. So, but anyway, Regina Mann is one of our agents, and she really participates a lot in our classes. And she reached out to me and says, Craig, who do you recommend to do my taxes? And I reached out to you and said, Mike, who's a good independent contractor tax person? And you said, well, my firm is. And I totally forgot you have a CPA firm on the side. So that's what we're going to talk about. But Ivy just got here. Lily, say hi to Ivy. Sorry for this brief interruption.
No worries. We can, Craig, if you want, we can start with questions or just a general discussion while you're doing that.
Yeah, I just want to say hello. All right, so I want to lead in a little bit. So let's talk about the real basic stuff. A real estate agent, should they be incorporated in some way, shape, or form?
Well, there's really two. We try to make it an economic decision because at the end of the day, a lot of us are concerned about what things cost. So around commissions of around 50,000, 50,000 is where the break even point occurs, where if you're under 50, you can be a Schedule C and you can report everything on your personal return. Above 50,000 is where the break even point starts to occur. You may need to be in a multi-member LLC or an S corp. So that's kind of our break even we've always used, and it seems to hold pretty well. The only thing that would change that is if your spouse or significant other in your family had a high net worth, or you had a high net worth, and you were trying to protect yourself from a liability standpoint. So if you had a high net worth that you want to protect, then it doesn't matter what your commissions would be. I would recommend you be in a multi-member LLC or an S corp, depending upon your other situations.
You know, I always ask you a question and you always give me a two-part answer, but it was a really good two-part answer. So $50,000 a year or more, really, you need to be you said a multi-member LLC. How would that work versus just a single member LLC?
Sure. The single member LLC in effect is a Schedule C. That is your personal return. You can have a multi-member. So like a lot of times they'll put their spouses on for 1 or 2 or 3 or 4%. So they get the asset protection of the partnership. So that's just a strategy that if you're looking for asset protection, you can have your spouse be a percentage.
Oh no, we lost them.
Sorry about that.
Well,
No, he didn't lose me.
Oh, you got a phone call.
No, I have these new Bose headphones. I can't figure out how to stop an inbound call from disconnecting the call.
Yeah.
Technology has gotten the better of me this morning. So I think the standard answer is most agents that are full-time in the business exceed that amount. So they should look. The next step normally is, how do I make it so it's not a monumental expense? Because with those types of corporations, you end up having a lot more complexity. And most of the agents that we use and we have as clients have a small payroll company that would allow them to have a payroll, because you have to have a payroll if you're an S corporation. And then if you'd like, you can do the things that you may not be offered anywhere else, which is where you could have a 401k of yourself. You could have a 401k for your children or your spouse, or you could have other things like writing off your car, your mileage, your cell phone, and it gives you an opportunity to lower your tax bill.
Got it. 401ks are interesting because you've made me max out mine every year, which we've been together, and I'm glad you have, because it's forced savings. Can an individual real estate agent,
Correct.
Can a 1099 have a 401k?
Yeah, not only can they have a 401k, we used to have this with another broker that we had, where they would have a setup where we would pull X amount of dollars per closing. So instead of it being kind of a percentage, it worked as a percentage of closing. So each time they had a closing, we were able to pull a little bit of money out for their 401k, so it didn't hurt as much. So yes, they certainly can. And if they employ their spouse or their children, they also can have potential savings in that area.
But that all you have to be incorporated to do those things.
You don't have to be incorporated, but what happens is the more complexities you put into a tax return, the more potential for liability. And as you start to make a lot of money, you become a target. And with real estate agents entering people's homes, there's usually a very high propensity of them getting potentially sued if something goes wrong in the transaction. So we like to make sure they understand that. It's something that a lot of people don't really understand.
Gotcha. Okay, so let's talk about just simple things. A real estate agent, typically should have a nicer car. How do you justify buying a nicer car if you're a real estate agent? Because you can write off your mileage, you can write off your car leasing versus buying, those type of questions.
Okay. So
Another incoming phone call.
Oh, he's a busy man.
That's going to be a trouble. So the first step is if you lease your car. So if you lease your car, and with most real estate agents, the mileage driven is, north of 18,000 miles a year. Now, since COVID, that has obviously changed radically. So the benchmark used to be if you drive, 15,000 miles or less, then you probably want to lease because it's a better tax treatment. If you drive 15 or more, you want to purchase. I think with COVID, that has changed that philosophy a little bit more because you just don't have as many people in your car. So that's more of a personal decision. But you can write off a vehicle inside of your business. The only unique thing that people want to know is normally in a real estate business, you tend to have larger vehicles. Even though you may like a sports car, it's probably not the thing that you want to have as a real estate person. So we tend to see larger vehicles, and they can be, if they're over 6,000 pounds, that's kind of a unique thing in the code, they can have, it can be written off in 1 year. So if you had an exceptionally good year, you could actually write the price of a car off in 1 year. And I have one question. Do I just hit the hand?
The hand is just somebody raised their hand and that puts them to
Oh, okay.
screen. That's okay. But we got a couple Q&As in the chats too. So like me, I drive an Escalade. Why would I do that?
Well,
I can write off the price of the whole car the first year.
correct. There's a lot of SUVs, larger SUVs are over 6,000 pounds. That allows you to write it off. It's just a unique part in the code. So vehicles are very good. You can kind of upgrade your vehicle, and that fits well within the model of being a real estate person, and you can get the write-off on your taxes.
Nice.
So vehicles are nice. Of course, any tools that you use in your business, the cell phone, office expenses, any kind of expense you spent, obviously everything in your office at home would be deductible. I do get a lot of questions about what I want to write off my home office. And that has really been, the IRS has really attacked that over the last 5 or 8 years. And when you look at the true numbers, it really does not take a lot of deductions. I mean, you can't allocate your electricity. You can't allocate certain things that are high dollars. And most real estate agents would find it very difficult unless they had a team at home to justify more than just a 8x10 room. So we tend to focus on areas that are outside of the house because I think you get a higher bang for your dollar.
Like, what's an example of what's outside the house?
So, if you wore a monogrammed shirt to your workplace. So I get a lot of questions about, can I write my uniforms off or can I write my clothing off? You can't write clothing that you buy at a retail store off. But if you have monogram clothing, then you can write it off. So if it fits into the uniform category, that's something that you have. A lot of agencies have their standard uniform, and they're going after that uniform look. Some agents want to be, they want to dress differently. So the cost of clothing is non-deductible if it's from a retail store, but if you buy it as more of a uniform and it's monogrammed, then it can be deductible.
It's simple enough.
Yeah.
Regina asks, what do you consider high net worth? When you have kids, none seems to be high enough.
I say that high net worth, in my opinion, is if you don't want to lose your money. So if you have enough money where you're worried about losing it, then you're high net worth in your opinion. I don't think it's a dollar number. If you have, enough savings where you're concerned that if you were to do something and they would sue you and they would take it away, then it's worth that extra step. So to give you an idea, the difference in cost is maybe $1,500 a year between being a Schedule C and a partnership or an S corp. So that's a very small price to pay for insurance to be protected. Now,
Like
when you look at
cost of preparing the returns.
It's
basically?
preparing the returns. It's the state cost. It's just kind of everything that goes into a return. Maybe $1,500 or $2,000 would be the total cost. The payroll company, all those things that you'd have to do. So after you look at liability, then the next step is to look at, does it actually save you much? If you say I've got, and I'm just making this number up, if you've got $300,000 that you're trying to protect in the equity in your home, or 500,000 of equity, is it worth $2,000 a year to protect that? And if that answer is yes, then that would kind of lead you in that direction.
Okay.
The next step that you'd want to look at is, what other things you can write off in a corporation. A corporation tends to allow you to have more opportunity to write things off than in an individual. So the cost, again, we try to make sure you have a benchmark, but I would say that $40,000-$50,000 of commissions is right around where it makes sense.
Right. But you said your home, if you want to protect the equity in your home, what did that protect under homestead?
No, what happens is, if you have, depending on where your assets are, the question about net worth, it depends upon where your assets are. So if you've got it in a stock brokerage account, it's much more accessible than if you have it, say, in a rental property. So those are the unique things that you have to address when you get into the situation with your provider.
Right. But I would think your primary residence would be protected under homestead provisions if you had homestead.
It is, but if you work out of your house and you write up in your house, then the attorney can attack that portion. And that's one of the other reasons, potentially not to be having your homestead be your office, because there is a possibility of an attorney. Yeah.
Never thought of that. I don't think I do take a home office deduction, actually.
No, we don't let you.
Kathleen said, if you have multiple real estate properties, land trusts, and an LLC, can you roll more into the LLC, like Roth IRAs and money markets and annuities for tax savings? Multiple properties on a land
A lot
trust.
of questions there.
Yeah, that's a complicated one.
So a land trust is a vehicle that you use to hold property. So a land trust will sometimes avoid people knowing who owns the property. So the question would be, if you have a land trust, normally that's just a shield in front of the owner or the beneficial owner. So you can put, if it's a rental property, then you should put it in an LLC, even if it's in a land trust, because the land trust simply allows you someone not to know who owns it, but it can be found out in a lawsuit. So the partnership rules allow you a much better protection than anything else. If you want to just have something that you don't want anyone to know about, then a land trust is also a good opportunity.
Now, I just bought a house and I put a rental house, and I called to get insurance, and the insurance agent advised me just to keep it in my name personally because my insurance would be cheaper. And
that is correct.
How does that protect me? She says, well, it protects you because you got a $5 million umbrella policy that protects you. So there's two different types of protection. The first is there's inside protection and outside protection. So inside protection is you're protected from the people that enter that home. So when you rent that home and they have a party and they have somebody slip and fall, that's inside protection. So that's insurance. So there's nothing wrong with that. So you should have insurance and they should have an umbrella. The outside protection is if you do something where it's outside of that environment. So you drive drunk one night coming home, and of course you never do that, I'm more than sure. You drive drunk coming home one night and you kill somebody, and that is one of the collection of your assets. They will attack that asset. So the liability protection from insurance stops the inside, but the outside protection is where it's more difficult. And then the second part of that is none of the insurances stop the nuisance lawsuits. So just because you've done everything right doesn't mean you can't be sued. So
the protection, the insurance doesn't stop the nuisances. So sometimes you can have this extremely high insurance, but you still have to come up with $10,000 or $15,000 to an attorney to protect yourself. If you have a multi-member LLC and it's taxed as a partnership, you'll find that most attorneys won't even attack it unless there's massive amounts of opportunity to get something, because they're on contingency. So the multi-member LLC avoids the nuisance lawsuits. Good question.
That's why I tell the agents all the time, when somebody comes at you and says, look, we're going to sue, it just tells me they're ignorant, because they're going to spend $15,000 to sue somebody for a $4,000 problem. So that was a good way you summed that
A
up.
lot of times they say that. Yeah.
So it's a vain threat. All right. So what value can we bring the agents this morning about their personal tax returns? Number one, should they go to H&R Block? Loaded question.
I think the biggest step is no. I think some people should. If you're under 50,000, I think H&R Block is a great low cost provider. You're probably going to be in the I hate to quote prices because it's different all around, but it's by far the lowest price. So that would be what I'd say for agents under 50,000. Agents over 50,000, I think the biggest problem why the cost goes up is that they aren't automated. So what they'll do is give their provider bank statements, credit card statements, and it's just this big arduous task of trying to figure out what's deductible and what's not. So the three things that we tell people are, number one is make sure your bank allows you to download your information into some sort of software, like a QuickBooks or anything like that. It's a very simple process. It'll probably save you 20% of your fee from a provider because they don't have to look at those statements. So that's number one. Number two, use one credit card and one credit card alone for your business. That way you can do the same thing. You can download the information. So now, if you've just done those two steps, you can, and you buy a QuickBooks software package, QuickBooks Online, it's, a few dollars a month, or you can do desktop. What you've done there is eliminate probably 50% of the cost that you would go to a provider, because you're not having to pay them in the busiest time of year to input bank statements. Okay. So those two steps are the first. And then I would recommend that if you're, again, north of that 50,000, that, October, November, December, you get with your provider and you understand what you've made, because I always have the same thing. I'll get an agent, they'll say, oh, I'm waiting on my statement from my broker to see what I made. And what that tells me is they're not looking at what they can do through the end of the year to reduce their tax bill. Okay, so the three things: download credit cards and credit cards and bank statements. Have one half-an-hour meeting once a year with their provider. And then number three, actually look at what they can do to lower their tax bill, because a few minutes of information can substantially save people from their tax bill.
You talk about things like at the end of the year, if you need a new computer, now's a good time to buy that because you can expense that.
Yep, of course. It's wow, you've done much better. Your average, like one of the agents we spoke to last year, her average was about 200, and she had done a fabulous year last year. She was about 325, and she really was surprised at that, but she had a flurry towards the end of October. And we made some decisions. We bought a car a little bit early. We were going to wait till March. But we decided to bring it back and buy it in the part of the year. She did do some infrastructure, which was a couple computers. She bought a new cell phone. So she did some things necessary to reduce the tax bill and let the government pick up part of her business expenses. So yeah, those three things can be done. And there's also to be virtual. That's the other last thing, is there's no need to bring your stuff in a box to an accountant or CPA. If you can step into a virtual environment where your CPA or advisor can be anywhere in the world, then you also will have the opportunity to reduce the cost and also increase your value from the provider.
What about a business checking account versus your personal checking account?
So if you are over that barrier, 50,000, then you open up your own entity and you'd have to have a separate bank account. So you'd have to have a business checking account. And that's kind of when things get fun, because there is a little bit more complexity. but there's also tremendous opportunity to reduce your tax bill by the things that you can do. I hear it all the time. People will say, well, I just don't know what I can write off and what I can't write off. And it's amazing how many things that you can write off in a business. The code is very specific. It states that you can write off expenses relating in the generation of your income. So that's very broad. So is the meal with your prospective buyer deductible? Of course. Is there any kind of marketing tools that you use? Okay. I always get the questions of, of clothing, outfit, all that. Those are non-deductible by the courts. But if you have anything that relates to how you make your money can be deductible. So those are things you need to discuss with your provider.
So if I took my spouse out to dinner and we talked about my business, would that be a deductible expense on my business, perhaps?
Probably not. What would be?
I wanted you to say yes to that.
Yeah, well, it would not be.
What if my spouse works with me?
Of course, if your spouse is an agent, or if your spouse is your administrative assistant, then you could be talking business.
Interesting.